Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Matt Lewis, head of ETF Capital Markets at American Century, Dave Sharp, senior ETF Capital Markets Specialist at Vanguard, Dave Stack, regional head of ETF Capital Markets at DWS, and James Kim, head of ETF Capital Markets at VanEck. We're here to discuss how the ETF Capital Markets function has shifted over time and how they expect the industry to evolve going forward. Gentlemen, it is great to have you all with us. Welcome to MarketSite. And Matt, let's kick this off here. You're seeing larger and larger trades come through. How is the ETF space working with market makers?
Sure, all of us across the table here work very closely with the ETF market makers, have a good understanding about what ETFs that they're really good at, understanding where they're pricing our ETFs, the information they need to ensure that they have quality spreads out there, receiving information back from them about how we can improve our products too, to make sure that our clients have good experience trading our ETFs.
Yeah, so Dave, you would work with market makers as you think about launching new products and hearing from what they hear from their clients, what they're looking for in terms of products and how to effectively get the best pricing for it.
Yeah, I mean, I think what's really important for the market makers is just that they understand the expectations when they come in to create or redeem a particular product, understanding any risks that they take when they're providing liquidity in that product. So it's really important for us to work with them even before we launch, finding the right parties, the right designated liquidity provider for the product that's going to fit well in that space, be able to provide really good liquidity right out of the gate, and ensure that the client has a really good experience.
Yeah, so it's not, the other Dave, it's not like it's a one-size-fits-all solution for every single product. You are going to be selective with market makers based on the underlying and other attributes about the product.
No, absolutely, and I would echo what everyone has said here so far. Essentially, we look at their core competencies when we're actually bringing a product to market. Like, does this line up to what they're really good at? And then we talk to them, we have that communication, we have that transparency, and all that goes to essentially the markets that the clients are experiencing after the product launches. When they see that spread on screen and they're interacting with the ETF, that's all because of the liquidity formation that happens from the market makers. But it all starts from the beginning when we're bringing a product to market.
James, it's interesting. It sounds like it's more of a partnership than just a vehicle to trade.
Yeah, it's 100% a partnership. I think the way we approach relationships with market makers, authorized participants, we try to ensure that it's a two-way street. So things like working with market makers, like Matt alluded to improve a product. Working with market makers on the trading side of some of the underlying securities or components associated with the fund itself. All of that, we take a very much holistic approach when choosing the appropriate lead market maker.
Yeah, and James, when you think about how the ETF capital markets function has shifted over time, what stands out to you the most?
So I think the biggest thing from a capital markets standpoint, especially as it relates to client interaction, is education. So I think a lot of times, a lot of clients still see an ETF, assume that it should trade like a single stock, but in reality, there's massive liquidity potentially as it relates to the underlying security. So going over the different liquidity profiles of each product, educating clients for best practices when it comes to execution, things of that nature, I'd say you would think we would be doing less of it, but to this day, I think it still continues on.
I would also add to that, just through the years of just working with clients, just letting them know what their resources are available, right? Whether it's the capital markets group at our firm or at the firms that are represented here, and as well as what's available at their firms, right? Their own execution desk, right? We can explain the liquidity, but when they go to their execution desk, they're going to get an incredible experience. That execution desk at all the wealth management shops that are here in the United States, they have put in, I would say, vendor applications that will go out and source that liquidity from APs and market makers. But that client experience is so important to us to make sure that they understand like what resources are available and how they can execute a trade.
Yeah.
Yeah, I think it's acting as that best execution consultant, really being able to help the client think about the best way to deliver that order to the market, to ensure that they're really thoughtful on best practices that exist for getting that best execution, really being a consultant for them and ensuring that we are a partner with them. And as Dave mentioned, that could be their own block desk, it could be their capital markets desk at an issuer. It's really just trying to get them to know, call for help. If you need to be able to see deeper into the liquidity profile of a product, we probably have some good ideas on how to limit your market impact.
Yeah.
Yeah, I'm just finding that ETF capital markets, in all firms are becoming the central excellence of ETFs. It's like they really understanding the holistic picture from the details about how the ETF is valued, from NAV calculation to how the market prices it, to how our clients utilize it, and everything in between. So, both internal education, external education, we're here as a resource for, all things ETFs.
Yeah, well, I also think, when you think about demand, whether it's from advisors, institutions, even their clients, it's so nuanced now, right? They're looking for the product that has that edge. But I want to talk about liquidity for a moment here, Matt, because volume doesn't necessarily equal liquidity.
That's correct. The volume is what just has been traded of that particular ETF. It's not what could have been traded. And it goes back to what James has said earlier about the underlying securities. The underlying securities has their own liquidity, and that underlying security liquidity can be sort of accessed for creating new shares of the ETF to fulfill large orders. So those are some things that we in capital markets help explain to clients internally as well. But again, it goes back to that can be sourced by advisors, by investors, if they go to the right resources within their firms, be it a block desk at a broker-dealer, be it a block desk or execution desk at a custodian that the advisor is trading on. So I think that's important. And again, volume that you see on screen is what's been traded. It's not what could have been traded.
And just piggybacking off of that as well, in a lot of instances, spreads might not be what the true spread of the product is as well. So just because a product's trading 20 cents wide, that might be a function of very little volume in the product, for example. And the market maker not taking the time to potentially price it, or for risk management purposes, pricing wider, because in the absence of volume, the market maker, of course, wants to avoid getting picked off by their competition. But in a lot of instances, if the client trades the ETF, quote unquote, the correct way, we see fills or executions occur inside that spread all the time. So that goes back to sort of the education piece that I was talking about. I guess highlighting spreads and volume, like regardless of how high or wide rather, or low, respectively, each of those are, that may not tell the full picture as it relates to liquidity of a particular product.
Right.
I would add one thing on the back of the comments here. As an ETF issuer, we build products for scale, right? So if the capacity is only 5, 10 million, or $100 million, that's probably not suited for an ETF. There's so much work that's done up front when we're bringing a product to market. We're bringing it for scale, so investors have that experience of like, hey, there's no volume that's traded in this ETF, but I can buy, $2 billion or $3 billion, wherever it might be. But that's that ETF creation and redemption mechanism. So like you said, volume on screen is what's traded in the past. It's not indicative of like the full liquidity picture of an ETF.
Well, speaking of volume, what about all the products that have come to market? Right.
Yeah, so obviously the ETF industry has grown tremendously over the last 5 years. Currently today, there's a little, at April month end, there was about 3,400 products that are listed. 1,800 of those have come to market since 2019, so 52% of products have, brand new products into the market over the last 5 years. Liquidity can develop, right, or may not develop, but the key here is that there is underlying liquidity that's available to them, but utilizing the resources that's available for an investor, whether it's through the ETF issuer or through their own execution desks at their firms, right, they can just be thoughtful about how they execute for smaller ETFs.
Yeah, well, I mean, because the trading dynamics are different for different types of ETFs, Dave.
Yeah, absolutely. I mean, I think when we look at domestic equity, where there's a lot of precision in pricing throughout the day, the market makers have a lot more clarity as to what is the value of that ETF at any given time. As you approach into international equity, now your settlement charges, your fixed fees, some of the additional less explicit costs that clients aren't looking at start to creep in. The fair valuation in certain products will start to give a little bit less precision in where is that ETF trading. Then when you get over to fixed income, there's really no centralized marketplace. There is no firm quotes in that market. So now you are taking a whole nother level of speculation as to where is that price. And that's where we see certain market makers are better in certain products because they've done the work to try to unwrap that risk a little bit and try to better understand the precision in pricing something that is maybe less precise in the market. And our feedback to clients might vary depending on the asset class or the particular product on how to approach that market depending on certain circumstances in the market.
Yeah, well, I mean, speaking of international, Matt, do you think, how will that impact T+1 settlement? How will that impact the industry? Because, I mean, that international aspect is going to come in there.
Certainly, T+1 has been a hot topic. It's coming pretty quickly here, be it after our next holiday we have coming up here. And we around the table and other colleagues within the industry have been working closely together with our custodians to ensure that we are ready for T+1, how it impacts that creation redemption mechanism of the ETF. We feel that we're in really good shape, well prepared to make sure that it's a smooth transition. Certainly there might be additional collateral costs that might show up in the creation redemption, but I believe that I don't think it's going to have that much impact on spreads, and I think that we're going to still see the quality markets that we have out there for these products that the market participants are already providing today.
Yeah, maybe just to add to that, I mean, when we look at, we've talked a lot about the 2 layers of liquidity that exist within the ETF and how that makes it such a great vehicle. In international equity, we tend to see that secondary market ratio, so how much trades just in the secondary market after it's created is higher than most products. For a lot of the heavily traded products, that's 98% trades in the secondary. So yes, there will be some additional costs in the primary market for creation due to extra collateral needs, but we think that it's still going to be muted, to Matt's point, because so much of it still will occur in the secondary market where those expenses won't be felt the same way.
Yeah, it's interesting. You already have, if we could do T+1, why can't we do 0 settlement?
Well, so that's, I think a really good segue into one of the points that I was going to mention. The T+1 dynamic, I think, has given sponsors a chance to innovate as well. So I think certain sponsors are even contemplating T0 settlement as well to facilitate market maker financing charges or fail rates associated with the US market move to T1 as well. So to your point, I think it's only a matter of time, and by time that might be 5 years, 20 years later down the line when potentially the US equity market moves to T0 as well. But I think given the work that the industry's done collectively together, we, at least in theory, should be ready for that as well.
Yeah.
Yeah, I would say that the industry has done so much work to be ready for May 28th. I think we're good. I think we're ready to rock, and we'll wait for the European markets to move to T+1 in
May 27th, and we're the 28th because we have the Memorial Day holiday. I mean, certainly the technology is there, right? I mean, financial services has completely turned itself around, compared to even just 20 years ago, settling transactions and so forth. So, I mean, without that, it would not have even been possible to consider T+1. But for the most part, I would imagine 99% of the industry is on some sort of automated process at this point anyway. Yeah. You have to be. I mean, if you want to be a counterparty, you're going to have to be.
Yeah, it took 17 years to go from T3 to T2, but only 5 to go to T1. So if we're on that pace, it won't be too long before we're at T0.
Yeah.
Well, hopefully we can just settle into the T+1.
Yeah, let's see how that works.
Let's give it some time. Let it settle in and maybe go to T+0 at some point.
So, Dave, let's talk about the 50 shareholder rule. Tell us what that is, and do you think it needs to be revisited?
Sure, absolutely. It's a rule that requires a continuous listing standards after 1 year of launch of an ETF, that an ETF has 50 shareholders. Years ago, when a product would come to market, essentially it would be available to be bought at any firm. After there were levered inverse fines years ago in around 2010, 2011. A lot of firms put in place product groups that were essentially reviewing products when they were coming to market. Now, these firms have put different types of constraints on what products that will be available on day one. It could be from an AUM, it could be an exposure, it could be spreads, ADV, whatever it might be. But what is clear is that the amount of time to get a product to scale, and as well as client diversification, takes a bit longer, because some firms will have it 6 months before they'll even look at a product. So as an industry, and we still want to obviously create new products, bring innovation, right? We need to revisit this rule as a group and say, does it make sense for ETFs? For we understand why it's in place, but does it make sense to maybe think about it a little bit differently? Do we need to move it from 1 year to 2 years or 3 years, and have a different approach to the 50 shareholder rule?
Right. So shareholder meaning an institution, or the 5 of us at that table, we satisfy 5, and then there's 45 more to go.
Correct. Yeah.
Right. So what happens then if you have a fund that's only launching, let's say with $100 million, not quite as big as some of the other products that are out there? Will you get enough shareholders and you just don't launch? How does that work?
No, so when we bring a product to market, I mean, it depends on the product and the asset class. Right. Some products can launch with $2.5 million. Some products will launch with 50, 100, whatever. It depends on what the issuer wants to do. as an issuer, we obviously want to go out and we want to talk about our products, but can't talk about it at certain firms when they're not available yet. So there's the pool of investors on day one continues to get smaller, and that's the reason why I think we should look at the 50 shareholder rule.
I think active will be, even another aspect of that, because I think a lot of the due diligence certain firms will have, they want to see a track record for active products and make sure that it's performing to the mandate that's expected from the portfolio manager. So that could even, make some additional challenges to that 50 shareholder rule as well.
Yeah, and Matt, are you seeing any discernible trends in terms of the type of products that clients are going to you for, whether it's thematic or a certain style, the way it's managed? What seems to be the hot button right now?
Certainly, we have a broad range of products from broad-based core portfolios to more concentrated portfolios. I think the broad-based core portfolio is still something that the clients are looking for. Active ETFs is a very big trend right now. Lots of new products are coming to market. We're seeing a lot of asset flows going to active ETFs, and particularly our core based products that we have.
Yeah, I mean, fixed income active ETFs, James, was certainly a hot topic at Exchange this year. I mean,
yeah, so I mean, so for us, I think on the fixed income side, so we have certain asset classes where we think active makes sense. So case in point are the VanEck CLO fund, CLOI. Right. From our standpoint, it makes sense to have an active manager manage that product. But I think from our standpoint, we're sticking with the roots from a passive standpoint, and we've seen a tremendous amount of success on that.
Yeah. Any trends at DWS that stick out?
Yeah, I mean, one thing is just the overall industry itself, right? Since the ETF rule in 2019, the amount of new products that have come to market that are active is the run rates between 65 to 70% of new products each year are active strategies, mostly focused on the equity side. Obviously, there's been fixed income active strategies in the market for some time now. I think that's one thing that we're watching. We've obviously brought our first active product this year, leveraging both sides of DWS, both the passive and the active side. So I think the space is going to continue to grow, and I think, it's not just us. Obviously, everyone at the table is thinking about active strategies that they can bring to market.
Yeah, and finally, Dave, any trends that stick out?
Yeah, I think on the active story, we brought two of our last 4 products that came out were active fixed income, core bond, and core plus bond. So entering that space where we only have one other active fixed income product. So we expect that will be a place of growth. We're still seeing a lot of the flows going to those core products. The low-cost, diversified products within our lineup is still, a champion of flows coming in, and we'll always have an eye to those products at the firm. But certainly, active, 75% of the products over the last year have been active. There's no easy index ideas left, really. So we'd expect to continue to see growth there. About 30% of the flows, relative about 7% of the assets. So just a really growing sector there that we're going to keep an eye on, and we're going to continue to take a look at.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.